Hi guys, this is Mr. Ibrahim the trader of Gova Trading Academy. So in this video, I'm going to be showing you guys how to analyze the weekly work zone and the monthly MEC zone in conjunction with structure and location. All right. So first thing first, these are some of the pairs I want us to analyze. These are some of the pairs I want us to analyze, okay? So we are going to analyze all these pairs. So the upper pairs are the ones that are good, but the lower pairs here are the ones that are bad. AUD, USD, AUD, NZD, AUD, CHF, AUD, Euro AUD, okay? These are the ones that are bad. But these ones are the ones that are good, having a good alignment and a good structure, okay? And the structure is also sitting in the right location. So these are all the pairs we are going to analyze. All right. So let us move on to the charts, to the candlestick charts. All right, so now back to the candlestick chart. Remember, the first thing we need to do is to mark the monthly equilibrium line, which is on the D1 time frame. So the next thing to do is to mark the monthly equilibrium line using the horizontal tool. So I'm going to mark it at the opening of the bullish candlestick here. I'm going to change it to a blue line. Now, if you notice, for the monthly equilibrium line, how do you analyze the monthly trade? How do you analyze the monthly trade? This is how to analyze the monthly trades. For example, every single month, remember, we usually analyze the monthly equilibrium line every first day of the month. That is every first trading day of the month. For now, the first trading day of the month of July is going to be Monday, 3rd, right? So that is the first trading day of the month for the month of July. Now, what about the month of June? What is the first trading day for the month of June? If we look at our calendar, you should be able to see that on the calendar here, the month of June, the first trading day for the month of June is on Thursday. So you can see Thursday is first, and Thursday is weekdays. It's a weekday. You understand? It's a weekday. But look at it. July is here. Look at July. You can see that the first trading day for July, this is the first day for July, Saturday. Saturday is not a trading day because it is weekend. Sunday is not a trading day because it is weekend. However, on Sunday, 11 p.m. on Sunday, market is going to open on Sunday, right? However, the monthly equilibrium line is going to be traded on the 3rd, which is Monday. You understand? Which is Monday. So that is it. Now let's go back to the charts again, to the candlestick charts. Now going back to the charts, remember I told you that after marking the equilibrium line, what you need to understand is how to determine the trend on the monthly. So to determine the trend, you need to switch to the H12 time frame to determine the trend for the month. Switch to the H12 time frame. After switching to the H12 time frame, then start determining the trend from there. What is the first trading day for June? The first trading day for June is around here. This is the first area for June. This is where June opened from. This area where I'm marking my green line here. That's where June opened from, okay? So when you look left from there, because from there, let us assume that market has not happened yet from here. Let's assume the market has not happened yet from here. When you look left from that area, you should be able to see, when you look left from that area, you should be able to see that markets is in a downtrend. How did I know this is a downtrend? Because of the structure, right? Because of the structure. Market gave us a structure like this. Can you see the structure? So generally, market was going to go down because this is a downtrend, okay? Now let's look at it again. So let me clean the area up again from here. Let us assume that that area has not happened yet. So if this area has not happened yet, it means that when we look left, the only formation you should be seeing when you look left is the formation that we are having here. You can see that there's a rally-based drop formation around that area, right? There's a rally-based drop formation there. So in a downtrend, we need to look for a rally-based drop formation. After looking for the rally, after seeing the rally-based drop formation, you need to mark the proximal line and distal line and wait for price to come back into the area and then expect price to go down. And that is exactly what happened in the area. So let us switch back to the D1 time frame. On the D1 time frame, let me zoom out the candlestick again so that you can see it. On the D1 time frame, I believe you guys can see that there's a rally-based drop here. Let me highlight it properly. I believe you guys can see that from here, there's a rally-based drop in this area. Remember, the small bullish candlestick you are seeing here is the rally in price, and the bearish candlesticks you are seeing here is the drop in price. It is like we are having something like this: rally, a small rally, and a massive drop. You understand? So eventually, you see that markets came there in the new month. Markets came back to the zone in the new month and then dropped down massively. So even without switching lower, one thing you need to do is to identify the zone. Before you switch lower, you need to identify the zone before you switch lower, so that when you switch lower, the zone is not going to disappear. I mean, so that when you switch lower, this area is not going to disappear when you switch lower. Because remember, when you switch lower, the candlesticks are going to break down into smaller parts, and you might not be able to recognize the true zone. So now, after identifying the zone, that this is where we have price. Market price has not happened yet as at the time of the analysis, which means this area has not happened yet as at the time of this analysis. You understand? Which means that when I was doing this analysis towards the ending of the month, because remember, how did I know this is towards the ending of the month? To know that this is the to be able to know that this is towards the ending of the month, I believe you guys can see that there's a period separator that came across this area like this, right? And on that period separator, remember there's a zone that we marked here. There's a zone that we marked here. On that zone, remember we are expecting price to come back into the new month and then drop down, isn't it? That is what we are expecting. Now, before that happens, I believe you can see that few days before before the previous month close, that is the month of May, few days before the month of May closed, when you look left, you should be able to see that there's a zone here on the left area, which is a rally-based drop area here. Can you see that? It means that it means that on the previous month, we saw a rally-based drop formation. Then price came back into the area. Our expectation is that there's a downtrend in price. As you can see, there's a downtrend in price. So what we did was we mark this zone like this, we mark it. So we identify the rally-based drop that is here. We waited for price to come back into the zone in the new month, and then we saw market price dropping down. So generally, we are able to identify the zone looking at the structure on the previous month, which is here. And that is exactly what we are currently having here. Okay. So you need to look at the structure on the previous month. I believe you guys can clearly see the structure on the previous month. Looking at it like this. Sorry, guys. Looking at it like this, I believe you guys can see that this is the structure. Rally-based drop, right? You might not see it clearly on these D1 time frames. That is why you need to switch lower to be able to see the zone a little bit more clearer. You can see as I'm switching lower, you can see that this is the zone here. Rally-based drop. Can you see that? So, and as at the time of the analysis, remember this area has not happened yet. As at the time of the analysis, this area here has not happened yet. As at the time of the analysis, okay? So it means that looking left, few hours before market close for last month, when you look left, you should be able to see that this is the only formation that makes sense on the left. So we are waiting for price to come back into the area, and then we are expecting price to go back down from here. You understand? And that is exactly what happened. You see how market price came into the zone, the new month. Remember, the new month opened from here. How did I know the new month opened from here? Look down from this candle. Look down. When you look down, you should be able to see that that is the first day of June. That's the 1st of June. That area is the 1st of June. Okay. So using the crosshair, you always use your crosshair to know the dates. So I'm putting my crosshair on this candlestick here, and I believe you can see the dates below. You can see the date here is 01/06/2023, which means that is where the month of June opened, okay? Which is exactly on this area where I highlighted on this candle, okay? So it means that after June opened here, after the month of June opened here, market price went up and then went down. Because when we look left, there's a zone in the previous month that banks were not able to complete. You understand? Now, to be able to mark this zone properly, because right now the risk on this zone is too much. Let's see how many pips risk it is right now. You can see this is 72 pips, 74 pips risk. So to be able to mark out this zone more properly, in a more proper way, you need, after identifying the zone on a higher time frame, because right now you can see I've already identified the zone on a higher time frame, which is H12, right? H12 time frame, 12 hours time frame. So I need to switch lower. You can see that before I switch lower, I've already marked it out roughly using the proximal line and distal line. I've already marked it out roughly. Marking it out roughly like that is not my final marking. I've not marked it in a more final way. The reason why I mark my proximal line and distal line right now is because I don't want to be switching lower and then the zone should disappear. I won't know which zone it is. So to be able to know which zone it is, always mark it out before you switch lower. So from H8, you can see on H8, we saw a rally based drop that represents the banks, isn't it? Remember I told you about momentum candlesticks. You can see their movements here. Banks are the only traders that can move the market in a momentum way going down like this. This is one of their footprints. So that area is also identified as a good area. Okay. So remember, this is the area for the month of June. This is where June opened from. So June opened exactly on this candle. June opened exactly on this candle here, which means that from all these areas on the left side, market price has not happened yet in all this area. Market price has not happened yet in all these areas. You understand? So, which means that the only zone that is making sense is when we look left, the only formation here in this downtrend that is making sense on the previous month, because remember, this is the month of May, right? This is the month of May. And this here, from this area here, this is the month of June. This is the month of June. So looking left, this is the only formation that makes sense. This rally based drop here. So by now, I believe you understand what I'm trying to say to you guys, right? You understand what I'm trying to show you guys. So from H8 to H6, from H6 to H4, right now I'm trying to teach you guys how to mark out the zone, okay? From H4 to H3, from H3 to H2, you can see this is the zone, right? This is the zone. From H2 to H1, so from H1 to M30, remember, whenever you are marking the monthly equilibrium line, you don't have alignment yet. You don't have alignment yet to be able to determine if it is buy alignment or sell alignment. Because remember, what we have is first day of the month. We only have the first day of the month. Before you can have a week, 7 days has to close before you can have a week. So it means that you need to, before you can have the weekly equilibrium line, 7 days must pass before you can have the weekly equilibrium line, which means that on the first day of the month, 7 days is not yet over, right? Has not yet passed. So you cannot have the weekly EQ during the first 5 days of the month. You can only have the weekly equilibrium line after 1 week has passed. You understand? Which means you only have the monthly equilibrium line. So it means looking only at the monthly equilibrium line, what we have to do is to mark the monthly EQ. After marking the monthly EQ, to determine whether it's a buy trade or a sell trade, we need to know the trend first. So let's say, for example, this is an uptrend. This is an uptrend. And then we saw something like this. You can see market price closed here for the month, let's say. So looking left, the last formation that formed is this area of draw base rally. And I'm taking this draw-based rally because I can see that we are in an uptrend. So the uptrend is telling me that I should go for a buy formation on the monthly EQ without having an alignment. You understand? So I should expect price to come here and do this. Vice versa for a sell trade. For a sell trade, after determining the equilibrium, after marking the equilibrium line, you need to determine the trend. So the trend is going to tell you whether it's going to be a sell trade and so on and so forth, okay? So you can see here, the trend is a downtrend. The last formation that formed towards the ending of that area is this rally-based drop that we are having here, okay? Which means I should mark the last formation here for last month or last week. That is for last month. I'm explaining the monthly EQ. That's for last month. Then I should wait for price to come here and the market price is going to go down. That is how to trade the monthly EQ without having the alignment, okay? So let's continue. You can see how I reduce the zone into a smaller part as I switch to lower, right? You can see how I reduce it. Now, I'm going to switch back to a higher time frame. Now, switching back to a higher time frame, you can see that this is the zone. The risk on this zone was, the original risk on this zone was 33 pips risk, and the reward, as you can see, the reward is 891 pips, 889 pips, as you can see, 889 pips. So how do we calculate pips? How do we calculate pips? Look at the circle here. Look at the circle here. How do we calculate pips? This is how to calculate pips. So using the cross here, using the cross, how many points is here? How many points is in this circle? You can see that the points in this circle is 1923, right? 1923, isn't it? So we need to throw the last number away. We need to throw the last number out. The last number here is 3, which means that you can see this is 1923 points. But in pips, if we throw the last number out, which is number 3, it is going to be 192 pips. You understand? It is going to be 192 pips. So if we throw the last number out here, then the last number here is 9. This is going to be 210 pips. If we throw the last number here, the last number here is 8. This is going to be 177 pips. So if we throw the last number out here, the last number here is 0. So this is going to be 184 pips. So that is how to calculate pips, guys, okay? That's how to calculate your pips. So you can see here, the last number here is 6. So in pips, this is going to be 200 pips. So I believe by now you guys know how to calculate pips. So let's move on. So you can see in this area, the risk here from the proximal line, don't calculate it from the distal line. No, this is very wrong. Calculating it from the distal line is very wrong. You need to calculate it from the proximal line, which is the 0.0 line, okay, the 0.0 line. So from the 0.0 line, drag it up a little bit. Make sure you place it properly. This is 33 pips. Remember, it is 33 pips because the last number here is 0. So dragging it down all the way down to where market drop down to, which is here, you can see this is 8,893 points. So the last number here is 3. So this is going to be 889 pips. Okay, so I believe you guys understand what I'm trying to do. Sorry. So I believe you guys understand what I'm doing here. Now you can see this is what happened in the trade for last month. From here, when market triggered here, market went down all the way down to this area. Okay, all the way down to that area. And that area gave us 889 pips. 889 pips. As you can see, let me do it again. Let me calculate it again. You can see that's 889 pips. So that is it, guys. That is it. So 889, so it means that 889 divided by 33 pips is going to be equals to is going to be equals to what? Use your calculator. Use your calculator. If we use our calculator, always use your calculator. Don't use your head. If we use our calculator, 889 divided by 33 pips is going to be 26. The answer here is going to be 26.939393, and so on and so forth. Okay. Remember, if we are to approximate this 9, it is going to be 27 here, isn't it? It is going to be 27. So, but don't approximate anything. Okay, don't approximate anything. Make sure you leave it as 26.9393. Always throw this area out. From these dots, always throw it out. We don't need here. We don't need it. Okay, so what we have left is 26, isn't it? So it means that this trade is giving us risk-reward ratio 1:26. 1:26. Okay, 1:26. So remember, the risk here is 33. From here to here, from this distance to this distance is 33. Is 33. Is 33. Okay. From this area all the way down to this area. Remember, market came down all the way here. So this area is 889 pips. So we divided the two figures together. This figure and this 33 figure here, we divided it together and we got 26. Okay. So if we got 26, then what is the, let's say for example, how much did you make? So this means risk. RRR means risk reward ratio. Okay. So the risk reward ratio we got is 1:26 on this trade. So if the reward is 1:26, how much did I make? How much did you make if you were risking $10 on this zone? How much did you make if you were risking $10 on this zone? Remember, from here to here, you risk $10. It means from here to here is going to be 10 times 26. Okay. The reward you get is going to be 10 times the reward you got. So 10 times 26 is what? So 10 times 26, it means that on this trade, you happen to make $260 on this trade. Okay, on this trade, $260 on this trade. Very simple. No matter what you risk in dollar, times it with the reward you got. That is how to do it. So that is it for this month, for the monthly trade on this gold. Okay, on this gold dollar. Okay, as you can see, this is gold versus US dollar. Okay, gold versus US dollar. So after you are done with the monthly trade, delete the zone, but don't delete the EQ. Don't delete the equilibrium line for the month. Don't delete it, leave it where it is. Then after 1 week is over, then you can go to the weekly time frame, which is H3. When you go to the H3 time frame, go and mark the H3 time frame EQ, which is the work. To mark the work, remember the candlestick on the period separator is a bullish candle. So this is going to be our work area. Okay. So let me change the color here to color green. Remember, work is green line, right? So as you can see right now, the alignment that we currently have right now is a sell trade alignment. The blue line is up. The green line is down. So generally, this is a sell alignment. Okay. This is a sell alignment. So in a sell alignment, we are only allowed to look for sell formation. Okay. Now, one thing you need to understand is that on the H3 time frame, you need to look for a formation. So let's say on the H3 time frame, this is what we have. So let us assume that this is the period separator. Let us assume that this is the period separator on H3. Let us assume that this is the period separator. Okay. So after assuming that this is the period separator on H3, it means that what we have left now is that market has been doing something like this in the area. So market closed here, around here, market closed there, which means that the blue line is all the way up here. The blue line is up. That's the monthly EQ is up. And then the weekly EQ is here. And then the weekly EQ is here, which of course is a green line. Okay, which of course is a green line. Which is a green line. Okay. So if the weekly EQ is a green line, you can see the alignment we have. You can see this is the weekly EQ, that is work, right? So it means that the alignment we have is a sell trade alignment, isn't it? Sell trade alignment. So in a sell trade alignment, what we are looking for is before the new week open, that is, this area here can be Thursday or Friday. Let's assume this is Friday. Let's assume this area is Friday. This area here is Thursday. This area is Thursday. Let's assume this area is Wednesday, and so on and so forth. Okay. And let's assume this area is Monday. So it means that on Friday, few hours before markets close on Friday, around here, few hours before markets close on Friday, you need to do analysis on Friday. You understand? Few hours before markets close. Now, few hours before markets close, when you look left, you can see that we have a sell trade alignment, number one. sell trade alignment, number one. Number two, we are in a downtrend movement in the market. Number two, that's number two confluence. Okay. The third confluence we have is that the last, when you look left to the area, the last formation that is making sense around that area is this rally based drop here. Is the rally based drop that we are having here, which means that you need to mark your proximal line and distal line in the area, which means you are expecting price to come back here on Monday or Tuesday or Wednesday, and then price should go down. You understand? That is what you are expecting. So that is how we usually trade the weekly equilibrium line. Okay. Now let's go back to the chart again. Let's go back to the chart. Of course, you can always slow down this video. You can watch it on repeat. You can put it on repeat and watch it over and over and over again till you understand the concept of what I'm trying to say here. So remember, this area has not happened yet on the H3 time frame as at the time of my analysis. So let's assume this area has not happened yet. So remember, this area here is what we call the Monday. Let's say this is the Monday here. Let's say this is the Friday here. Let's say this is the Thursday here. Remember, this is just rough analysis, okay? This is Wednesday here. So what I'm trying to do here is, remember I told you guys that we are trying to analyze what happened on the previous week. So on the H3 time frame, this area is what separates the week, right? This is what separates the week. So this is the previous week here. And we are going into a new week here. We are going into a new week, which means this is the previous week. And it means this is the new week. So let me erase this a little bit. Let me highlight this area again. Now, this is what we are looking at. Remember, on the previous week, we are looking left. Remember, this area is the previous week. When we look left, this area is part of the previous week, isn't it? And the formation, the last formation there, when you look at it properly, when you look left, you should be able to see that looking left, the last formation is this area, is this one here, is this one. Remember, the first thing we look at is the alignment. We have a sell trade alignment. The blue line is up, the green line is down. The market is also down. Can you see? Downtrend. So that is why we have this area. Look at this area. Can you see this area? There's a formation here of a rally-based drop. But to be able to see the formation clearly, you need to highlight. Remember, I told you guys, you need to highlight the area first, so that when you switch lower, that area won't disappear. So this is H3 time frame now. So I'm going to switch lower from H3 to H2. Also, one thing to note is that whenever you are switching lower, don't switch from H3 to H1 or from H3 to M20. No, you have to switch one by one from H3 to H2, H2 to H1, H1 to M30, M30 to M20, one by one. Don't jump. Okay, don't jump the time frame. Always do it one by one. So let's do it again. From H3 to H12. On H12, you can see the formation here last week. This is last week formation. But the formation is not very clear to me. It's not very clear. So I need to switch lower again to make sure this is a good formation. So as I switch lower, this is the area, okay? You can see the area. So I still need to switch lower to confirm the formation clearly. So from H1 to M30. So on M30, you can see this is the area, this is the formation, rally base drop, okay? So on M30, I've already confirmed the formation. So what I have to do now is I need to mark my distal line here. Your proximal line should be here, okay? Just go back and watch the video. Go back and watch the video on how to mark proximal line and distal line, okay? Just go back to the video and watch how to mark proximal line and distal line. So I'm going to highlight the area with my yellow box to mark this area as my area of concentration. So you can see that's why price came back. Remember, this is the previous week. This is the previous week here. From here, this is the previous week. And this one here is the new week, So in the previous week, we saw a rally-based drop. You understand? And in the new week, price came back in the new week and trigger here and then went down. You can see that price went down. So that is massive. That is massive risk reward ratio, okay? So this is location. How to identify the area is what I determine as location, okay? You need to understand how to determine the area. You can see when I was determining the area, I was looking at the area from H3 time frame, because on H3 time frame, we know that from this line, anything from here is previous week, and anything from here is new week, isn't it? Previous week, new week. On this previous week, the last formation that makes sense around the area is this one here, isn't it? This rally base drop. So that is how we were able to determine the location of that trade, okay? So that is how to do it. That's how to do it, all right? Even if you are using the daily equilibrium line, on the daily equilibrium line, what you have to look at on the daily equilibrium line is that look for a zone on the H2 time frame. You can see this is H2. Remember, I told you this is 24 hours time frame. This is 24 hours time frame. So even on the DEQ, if you are analyzing the DEQ, you should be able to see that there's a rally-based drop yesterday. When you mark that area, you see how price came back to the zone the previous day and went down. So, but for now, even though for now, I told you guys to only focus on the monthly and the weekly. So I believe you guys understand why this trade worked out on gold this month, okay? That's the previous month. Now let us analyze another one, which is gold euro, gold versus euro, okay? Gold versus euro. So on this gold versus euro, the first thing to do is to mark the monthly EQ on the D1 time frame, which is on the period separator here. Change the color to blue. Lock the line. Switch back to H12 to determine the trend. When you switch back to H12, you can see the market structure. This is where the month opened from. This is where the month opened from. So looking left from that area, we can see that the market structure is like this, right? So price came back. We should expect price to continue with that trend. You understand? So that is it. So you can see on the previous month, there was a rally-based drop on the previous month. Price came back in the new month and trigger and then went down. That is it on the trade for you can see this is the area. You can see the previous month, there was a zone here on the previous month. So when you look at it from the D1 time frame, you should be able to see that this is what we have. On the period separator, right now I'm trying to teach you guys location, okay, location, how to determine location. So on the D1 time frame period separator, you need to look left for the formation that makes sense. The last formation that makes sense around this area is here, towards the ending of the month. You know, when the month is about to end, market price was close to this area here, isn't it? Which means that market price was trying to reference this area. So when you switch lower to a lower time frame, that is when you can start determining which trend it is. You understand? You should be able to start to determine which trend that area is. You can see the trend is market has been giving us something like this. So in general, it is a downtrend. We waited for market price to come back on the first day of the month. Remember, the first day of the month is here. Using the cross here, you can see this area is the first day of the month, which means the first day of the month open here, around here. Okay, that's where the first day of the month open from. So which means that few hours before market close last month, this area has not happened yet as at the time of the analysis. As at the time of the analysis, this area has not happened yet. Okay. So it means that towards the ending of the month, market went to trigger towards the ending of the month. Market went to the area here to trigger it. Then we have the new month open here. The new month open around here. You understand? And the markets continue going down. So that is how to analyze the monthly equilibrium line without the alignment. Okay. Now, after analyzing the monthly trade, monthly EQ, the next thing you need to do is to leave, don't delete the monthly EQ, okay? Don't delete it, leave it there. The next thing to do is to go to the H3 time frame to analyze the weekly trade for the new week. So the weekly trade is going to be here. Remember, all this analysis I'm doing is what happened in the past month of June, okay? Is what has happened in the month of June, okay? So now I'm going to change this one to color green, this horizontal line here to color green, because the weekly is green line. Also, I'm going to put my green line properly at the opening of this bullish candle here, which is here. Okay, I'm talking about this area. So you can see how I put my green line at the opening of the candle here. So you can see again, the alignment here is still a sell trade alignment, isn't it? Sell trade alignment. So last month, even though this area has not happened yet, remember on the H3 time frame, the location of this trade, this area has not happened yet. The last formation last week, that formed last week, after the period separator, this is the last formation that makes sense around the area. And we are in a downtrend, we are in a sell trade alignment. And there's also a downtrend, you understand? So all these things are confluences that we should be looking at. So the formation, this is the last formation that is making sense around the area. And for me to be able to know if that formation is the one that is making sense, I need to switch lower. But before I switch lower, remember I told you guys that you need to highlight that area so that when you switch lower, that area is not going to disappear. So from H3 to H2, H2 to H1, you can see the formation is a good formation of a rally-based drop, a very good one. Assuming the formation was giving me a candlestick like this, a drop in price like this, I won't take that formation serious. I'm going to ignore it. But you see, this is a very good A-shaped formation, right? A good rally-based drop formation. So I'm going to continue looking at it. Now, you can see this is the right way to mark your proximal line, distal line. Highlight this area with your yellow box. Mark the area with your area of concentration. So sometimes you might not see basing candlesticks on your zone. Sometimes you might not see basing candlesticks on your zone. Now, if you are not seeing basing candlesticks on your zone, this is another way to mark your proximal line, okay? Distal line is very simple to mark because we all know that distal line is it should be at the highest point of the base. If this is the rally in price, this is the base, and this is the drop in price, it means that this is the rally in price, this is the base, and this is the drop in price, which means that the highest, remember, this distal line says that for a sell trade, mark your distal line at the highest point of the base. The highest point is this area. So that is going to be our distal line. The wicks, always count the wicks in part of your distal line, okay? Make sure you count it like that. Don't do it like this. This is wrong, this is wrong, this is wrong, okay? This is wrong. Make sure you put it at the tip properly. Make sure you put it at the tip properly. So this is the right way, okay? Make sure you put it at the tip. So the next one is the distal, is the proximal line. For the proximal line, another way to mark your proximal line in a situation whereby the formation doesn't have basing candlestick is, look at it this way. we have a bullish candle, a bullish candle, and a bullish candle. We have a bearish candle, a bearish candle, a bearish candle, bearish candle, bearish candle, bearish candle, right? Now, does it make sense for me to mark my distal line here? Yes, it makes sense to mark my distal line here. Does it make sense to mark my proximal line around here? No, it doesn't make sense if I mark my proximal line there. Also, the definition of a proximal line, it's in the definition of proximal line, it says that mark your proximal line at the opening of a bullish candle. So the only bullish candle I can see in this area is this one. So the opening of that bullish candle is where I'm going to mark my proximal line. So it means this is the area and distal line is going to be here. So if we use the proper tool to mark it, it is going to be like this. And then highlight the area with your yellow box to mark that area as your area of concentration. Whenever you are marking it with your yellow box, remember I told you not to do it like this. This is wrong. This is wrong. Don't do it like that. Don't do it like this. It is wrong. Also, don't do it like this. It is also wrong. It is also wrong. The proper way to mark, to highlight your zone is to do it like this. Just a little bit like this. So this is good, okay? This is good. It is not good also like this. If you do it like this, if you do it like this, it is not very good. It is not good, okay? So just know how to do all these things in a way that makes sense, okay? In a way that makes sense. So you can see the risk here for last week, weekly equilibrium line, the risk we took here is, let's calculate the risk. The risk here is from the proximal line. You can see the way I put my crosshair on the proximal line, and then I drag it up to the distal line, which is 36 pips risk. So this 36 pips risk now down to where markets came down to, which is here. Remember, this was the risk. From here to here is the risk. So that's the risk. So now we are trying to calculate the reward. So the reward is this. So this is the reward. From this area all the way down to this area, that's the reward. Okay, that's the reward. All right. Because markets came all the way down to this area. So that's the reward. and that is where we are going to be calculating the this thing. So let's calculate it from there, from the proximal line all the way down to this area is how many pips? You can see this is 3,550 points. The last number here is 0, so which means that this is 355 pips. So 355 pips is the reward, and the risk is 36 pips. So 335 divided by 36 is going to give us what? Is equals to what? Use your calculator. So using your calculator, you should see this as your answer. It is 9.30555. So remember, I told you guys to always throw this out. We don't need it. So it means that this trade gave us 1:9, okay? This trade gave us risk-reward ratio 1:9. 9:9, okay? So it means this is 9 and here is 1, okay? So that is it, guys. That is it. So that is how to analyze the professional course, okay? You can see it is very easy. It is very easy. Trade like a professional in a in a professional way. Don't doubt your analysis and so on and so forth. So you can see this is a trade. This is a rule-based trading. This trading is based on rules and regulation. You understand? It is not based on guesswork. And this is not smart money concept, okay? It is far from it. So that is it, guys, on this trade, all right? Let's move on to the other trade, which is Euro GBP, which is gold GBP rather. You can see this is gold versus GBP. So I'm going to be doing this very fast now because I believe I've told you what we are looking for. So let me zoom it out. Some of you might not see the candlestick properly whenever you want to mark your equilibrium line. So you might just zoom in a little bit, mark the equilibrium line. After marking the equilibrium line, change the color to the color of the equilibrium line you are marking, lock the line, and then zoom in back, zoom your chart back to the normal size. This is not a 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 normal size. Okay. However, this is the normal size your candlestick should be. Yeah, this is the normal size. Okay, this is the normal size. So now, let's continue analyzing the weekly, so that we can be fast. I believe I told you guys how we analyze the monthly. To analyze the monthly, we look for the trend, and then we look for last formation. Okay. So on the weekly, after marking our monthly EQ, we go to the weekly area and mark the weekly EQ also, which is here. So let me zoom it out so that you can see where I mark it. You can see I mark it exactly at the opening of this candle. I mark my weekly EQ at the opening of that candle. Okay. So let me zoom my chart back in. So remember, this area has not happened yet as at the time of the analysis. So it means that last week, this was the zone we saw last week. The last formation that formed last week is this area. Because remember, this is the previous week and this is the new week, right? So towards the ending of the week, the last formation is this formation here. Remember the confluence, the blue line is up, the green line is down, sell alignment. And that sell alignment is also in a downtrend. Can you see in a downtrend? So all these things are what we look at, all right? So the formation that makes sense towards the ending of the week is this area here. So let me switch lower from H3 to H2, from H2 to H1. You can see this is the formation, right? So for you to be able to mark the formation, you need to switch lower from M30. So this is enough. So in this situation, it doesn't make sense if I mark my proximal line at the opening of a bullish candle, which is here, because it means the zone is going to be too big. So it makes sense if I mark my proximal line here, okay? But let me switch lower again to see if there's basing candlestick. There's no basing candlestick. So I'm just going to put my proximal line here. I'm going to put my proximal line here, okay? So that is how to mark your zone. You need to be able to know how to be flexible in your analysis, okay? So that is it on this one. I believe you can see that they look the same, right? They almost look the same. So that is it. You can see in a downtrend, you can see markets continue with a downtrend in our favor, right? You can see the structure is there. You can see the structure has been there. So this is what professional trading is all about, okay? This is what professional trading is all about. Let's move on. Let's move on. Gold, Australian dollar. Now, on this gold Australian dollar, let's mark the monthly EQ on the D1 time frame. So let's just continue on how to take trades on the, so let's just continue on how to take trades on the weekly EQ. Since I've already shown you what to look for on the monthly EQ, how to analyze the monthly EQ. So now on this weekly EQ, you can see I've already marked my monthly EQ. The next thing is to switch to the H3 time frame to mark the weekly EQ, which is exactly here. Change the color to color green. Then on the H3, remember as at the time of the analysis, this area has not happened yet. So remember, this is the previous week. This is the previous week. This is the new week area, right? And this is what indicates that that is what we have. Previous week, new week rather, and this is the previous week. Now, in this previous week, the last formation that formed towards the ending of the previous week is this area here, right? And remember the reason why we are looking for sell trade. Do you know the reason why we are looking for sell trade? The reason why we are looking for sell trade, number one, is because the blue line is up, the green line is down. Also, remember this is a downtrend. Can you see? So all these things are what we look for whenever we're analyzing. So the last formation towards the ending of the week is here. Let me start switching lower to be able to determine if it is a good formation or not. Here, it is a good formation. After I switch lower, you can see how good the formation is in that area. So let me switch to 30 minutes to be able to mark the zone properly. So you can see I can put my distal line here and I can put my proximal line here. So I'm going to highlight this now like this. So you can see price came back into the new week. Price came back in the new week and trigger your trade here. and then market price drop down. Nice trade, very nice trade, very nice trade. Okay, very nice, very nice. So remember, this is the new week, and this area is the previous week. This is the previous week area. So the new week opened from here. Okay, new week opened from here. Markets then went up and then came down. Do you think it is coincidence? Do you think markets went up coincidentally into this area? Hell no, hell no. Okay, there's a reason why markets came here. The reason is because last week here, banks were not able to complete their transaction here. So they came back in the new week to complete it here. You understand? So that is how you need to be able to trade. Your mentality should be like this. You understand? Your mentality should be like that. So anyways, that is it, guys. That is it on this one. So let's go to GBP JPY. On GBP JPY, the first thing to do is to mark the monthly EQ, which is exactly here at the opening of the bullish candle. That is on the period separator. It is a blue line. I know that. So the next thing to do is to go to the weekly time frame, which is H3 equilibrium line. Mark it here at the opening of the bullish. Change the color to color green. Then let me zoom in the candle. All right, so you can see this is buy alignment, which means I'm only looking for a buy trade formation in this buy alignment. The blue line is down, the green line is up, which means buy alignment. All right. In this buy alignment, remember this is last week, right? This is on the H3 time frame. Remember, this area has not happened yet, indicated by that H3 period separator, right? So it means this is previous week area, and this here is the new week that has not happened. You can see it is still empty. The new week is still empty. However, looking towards the ending of the week, you can see there's a formation around this area. There's a formation around this area. To be able to see the formation clearly around that area, sorry, sorry guys, you need to switch lower. But before you switch lower, remember I told you guys to always put this on your chart so that when you switch lower, the area won't disappear in your eyes. So from H3 to H2, you can see when I switch to H2, you can see this is the formation of a drop-based rally, right? That area is a drop-based rally. How did I know it is a drop-based rally? I believe you can see this is a bearish candlestick came down and a bullish candlestick that went up. So that is it, okay? So let me continue switching lower. So you can see it again. A bearish candlestick that came down and a bullish candlestick that went up, giving us a formation of a drop-based rally, all right? Sorry, please. So it means that is the formation that makes sense last week, all right? Now, marking the formation, remember, you should mark the formation. You can mark it like this. So let me see if it has basing candlestick or not. All right, you can see this formation has basing candlestick, isn't it? Remember, this is the formation here. This is the formation. Drop base rally, drop base and a rally in price. And the formation has basing candlestick. Remember, what is basing candlestick? We have two basing candlesticks here. We have a bullish candle and a bearish candle. First thing first is to mark your distal line, which is below here. Second is to mark your proximal line as the opening of the bearish, which is going to be here. So if I use the tool, my tool here to mark it properly, I'm going to carry my distal line 100.0. I'm going to put the distal line here. And then I'm going to carry my proximal line and put it at the opening of the bearish. So you can see how to properly mark your zone. So you can see how price triggered here and then did what? And then went up to buy. Okay, so that is it, guys. That is it. It means that last week banks were not able to complete their transaction here last week. They came back in the new week to complete it. You understand? So remember, this is the new week area, and this area is the previous week. This is what separates the week, right? This is what separates the week. Remember, this area is what we have our EQ, our weekly EQ is here. So from the weekly EQ, we look at the last formation that formed. The last formation that formed that makes sense is this one for last week, towards the ending of last week. You understand? So, and that gave us a nice risk reward ratio. You can see this is how many pips risk? This is 22 pips risk. The reward here is 204 pips. This is 204 pips. Very nice trade. Very nice trade. You can see the blue line is down, the green line is above. So this is beautiful analysis. You can see we are trading in line with the words, with uptrend. So that is it, guys. That is how to analyze in a professional way. All right. So let's move on. USD JPY. On USD JPY, this is the daily EQ. So let me do this. Mark the monthly EQ here at the opening of the bearish, because you can see this is a bearish candle here. So I'm going to put it at the opening of the bearish. I'm going to change it to color blue. Sorry, guys. So I'm going to switch to the H3 time frame to mark my weekly EQ, which is at the opening of this bullish candle here. I'm going to change it to color green because weekly is a green line. And then I'm going to reduce the candlestick to its normal size. And then remember, last week on the H3 time frame, remember, this is location. This is how to determine the location of your trade by looking at the previous week to know the last formation that formed towards the ending of the previous week. So looking at this area, you can see that there's something around here. But to be able to see that area very clearly, you need to switch lower, right? You need to switch lower to be able to see if that area is a good formation or not. If the formation here is not a good formation, then the next formation is here, right? Is here. So before I switch lower, I need to highlight the area like this so that it won't disappear as I switch lower. You can see as I switch lower, you can see the formation of a drop-based rally, right? So you can see the formation last week makes sense. Towards the ending of last week, you can see this is the formation, drop-based rally. All right, so I've seen the formation of a drop-based rally, which happened towards the ending of last week. So I need, remember, the alignment is what? Remember, the alignment is buy alignment. The blue line is down, the green line is up. So this is a buy alignment, okay? Which means we should only be looking for a buy trade, all right? So switching lower, remember on the H3 is where we identify the formation that formed. So this is the area we are looking at. The last formation that formed towards the ending of last week is around here. So that is what you should be looking for. Now you can see the formation here. As I switch lower, you can see this is the last formation. So this is the new week area. This is the previous week area. So this is what separates the week, okay? So this is the new week. This is the previous week. All right, guys. So towards the ending of the previous week, the formation here is what makes sense, all right? So I believe by now you understand what I'm talking about. You can always repeat, you can always go back and watch this video on repeat. So I'm going to mark my zone here. So personally, I miss this trade because I happen to mark my proximal line here. I happen to mark my proximal line here. So personally, I miss an entry on this trade, okay? My trade did not trigger, okay? But I see some of my students that put their entry, their proximal line here, even though that is not the right way to mark your proximal line. The right way to mark a proximal line is after you've seen the basing candlesticks. You can see I've already seen the basing candlesticks here. So I don't see any reason why you've already seen the basing candlestick below here. So I don't see any reason why you should be marking your proximal line above the basing candlestick. That is not the rules and regulation. The rules and regulation says that mark your proximal line at the opening of the bearish candle for a buy trade. And this is where the bearish candle basing candlestick is. You understand? It is okay to miss some opportunities in the market. It is okay. So you can see I missed this trade by how many pips? So you can see I missed this trade by how many pips? Let's look at it together. Using the cross here, I missed this trade by from the proximal line up to this area here. I missed this trade by 4 pips, 4 pips, 4 pips, 4 pips. Okay. So, but it is okay. But however, you can see this is a very nice trade, assuming it triggered. For those who it triggered for, congratulations, but that is not how to mark proximal line. All right. So that is it. Okay. Now let's move on to Euro JPY. On Euro JPY, the monthly EQ is here. Monthly EQ is here. This blue line, it is a blue line. So you can see the reason why it is always good to change the color of your lines so that you know the trend, that the alignment you have. So this is a green line here for the week. So let me reduce the size of my candle to normal size. Now remember the location of the trade of the zone we are looking for. From H3, remember when we erase this out, as at the time of the analysis, those areas has not happened yet. So it means that towards the ending of last week, we saw this formation towards the ending of last week. That is the last formation that makes sense towards the ending of last week. All right. So remember, the blue line is down, the green line is up. We are looking for buy trade since this is buy alignment. Also, market is in an uptrend move, right? Uptrend. So all this is indicating to us that hey, you should only be looking for buy trade opportunity. So the this is the area I'm going to highlight because that is the base, okay? But as I switch lower, I happen to see that there's a break in the zone. You can see this is a general drop base rally, isn't it? A general drop base rally in general. It is a drop base rally in general. But when you switch lower, sometimes you might see that the zone is broken. So you can see that there's a little bit of break here. So when you see this type of break on the candle, it means that you should mark these two zones. These two zones are important. You should mark the two, okay? So marking the two zones, it means that, let me switch lower more. It means that my first zone is this one. My first zone is here. my second zone is here. It means my second zone is here. So you can see I mark my distal line here and my proximal line at the opening of the bearish candle. Okay. So by now I believe you guys understand how to do all this analysis. So you can see price came into the first zone and then went up. Sometimes price is going to come into the second zone, hit stop loss on this first one and come into the second one and then rally up. So you are still secured. You are still secured. If you hit stop loss on the first one, when price come into the second one and market is going up, you've recovered here. You hit stop loss here and you recovered back when price was shooting back up again. Okay, so that is it. So you can see sometimes you need to mark double zones. You understand? You need to mark double zones. Okay, so that is it on this analysis. Don't forget why we took this analysis. Buy alignments and a good market structure of an uptrend, okay, of an uptrend, and also a good location. The formation is in a good location, okay. So that is it. Okay, all right, that is it. Now let's go to NZD-JPY. On NZD-JPY, this is what we have. This is the monthly EQ. The weekly EQ is here. So zooming it out, you can see the last formation that we have towards the ending of last week. This area has not happened yet as at the time of the analysis. The last formation that formed towards the ending of last week is this one here, all right? Is that one. So it means that is the area, okay? That is the area. And that is why I mark it. So you can see we are in a buy alignment. As you can see, the blue line is down, the green line is up, buy alignment. Now, as I switch lower, I see that the formation is here. You can see what we have on the formation. You can see that the formation is a drop-based rally formation. Price came back into the zone and then price went up, as you can see, right? So that is it, guys. That is it on this trade. So I believe you guys understand the reason why I took this trade. Drop-based rally and so on and so forth. Buy alignment and so on and so forth, right? So that is it. Let's move on to. So let me stop this video here. Let me stop the video here. I'm going to continue the video on another part of the video. Okay, let me record another video. So I don't want this video to be too long, but we are not done yet. We are not done yet. All right. So guys, I believe you guys by now understand, are getting the point of how we analyze in the professional course. Okay. So if you have any question, feel free to ask me your question in the group.